Arne Sorenson, CEO of Marriott International. Great to see you again. Thanks for having us here.
Thank you. Good to be here.
One of the priorities for Marriott has been a revamp of the Sheraton brand. This is your third largest brand. What specifically are you doing on that front?
Well, we are relaunching Sheraton in many respects. So when we bought Starwood, of course, Sheraton was a big part of Starwood's business, about 45%, biggest brand that they have. It's now the third biggest brand in the entire Marriott portfolio. Sheraton had not gotten the tender loving care and the attention it deserved. What kind of attention? Really, what are the brand standards? What should these hotels be made to look like? What's the strategy for the brand? Are you being disciplined with applying those standards so that if a hotel doesn't meet the standards, they get out of the system? None of those things had happened. And so we came in and said, with our hotel owning partners, we've got a brand. It has an extraordinary legacy. It's been in business for many, many decades. It's big. It's economically significant to us and to our owners. Let's figure out what those standards should be. Let's apply them with discipline. Hotels that are not going to meet those standards, let's have the strength to get them out of the system. And so that's all of what's underway. And of course, we're showing here this week some of the ideas for the public space of Sheraton, which we're really excited about.
We're sitting in a mock sort of lobby or lounge that we might expect at one of the new Sheraton brands, Sheraton properties. Can you talk about some of the features that we're sitting in?
Yeah, and so the idea is for both existing hotels that will be renovated as well as new hotels, how do we pull through some of these ideas? And really Sheraton is about being located in place. It's about being the center of a community. It's about a place where people can come together. And so one of the things we've got out here, which is fun and interesting to people, is we've got sort of a work table. It's a communal table, if you will, but it's meant for folks to come during the day, if they're doing emails or if they have some writing to do, they got a place to do that. We've left a place in that table for them to lock up their stuff. So if you got to go to the restroom for a minute, you know, one of the questions you end up with in a Starbucks or in a restaurant is, what do I do with my stuff? Well, here's a place for them to leave their stuff quickly, come back afterwards and resume sort of their effort. And then, of course, lots of food and beverage, lots of life. Varies a little bit over the time of the day. Evening it'll be even more lively than during the day. But the notion is to bring this sense of community and a sense of place back to the hotel.
How is technology helping you figure out what customers want, and how is technology changing your relationship with customers, particularly on the cloud? How is all that working?
Well, it's fascinating. I mean, we have probably the most powerful tool we have to relate to our customers is our loyalty programs. We've got 110 million members between SPG and Marriott Rewards. Those platforms will combine in August this year to be one loyalty program, which we're really excited about. But through that platform, we know who our customers are. We know where they've stayed with us. We know something about their preferences. We know how to welcome them when they show up in their hotels. And they know how to reach us. So one of the things that's been really interesting, whether you think about Sheraton or you think about merging the loyalty programs, is our customers co-create with us. They are passionate about saying, this is what we want you to do, or maybe this is what we want you not to do. And by listening to them and being engaged in dialogue with them, we actually intensify the loyalty and the ownership they feel for our system.
So aside from doubling down on the Sheraton brand, you're also testing a home sharing program in London, I assume to compete with the Airbnbs of the world. Why are you doing this, and are you worried about any cannibalization to the traditional legacy Marriott brand?
So obviously we've all watched the home sharing market develop in the last 6, 7, 8 years, something like that. Airbnb probably gets more attention than anybody else, but Booking.com has got a good home sharing platform in Europe particularly. Expedia is in the space. You've got a number of others who are getting in the space. When it started, it was by definition smaller. It was in many markets illegal. In some markets it is still illegal. We've been asked many times over the course of the last few years, do you regret not having gotten into it at the beginning? And my response has often been, a company like Marriott cannot enter a business which is illegal. The consequences for us would be quite different than the consequences for a startup company. But we've watched this space develop, and one of the things that's obvious is, as it has grown, without branding, without curation, without delivery of services, it's a bit of a crapshoot on whether you're going to end up with an experience which is good or not. And we said, let's bring the discipline we have around services, around design, with a partner, Hostmaker, who was launched with us in London, and say, we're going to bring our brand to this space, we're going to bring our loyalty program to this space. It's going to be whole homes only. It's not going to be an extra bedroom in somebody's flat. That makes it different from a traditional hotel product, right? The sort of single guest room. And let's try and do something which is better than what's been done before. We just launched about a month ago in London. We're very encouraged by the results so far, and I think it's a space we'll stay in.
Would you be open to expanding to other cities?
Oh, absolutely. Yeah, I suspect we will shortly.
Any idea where at this point?
Well, we'll announce it when we get ready to, when it's ripe, I suppose, for announcement.
Fair enough. Let's talk about the economy, because I think a lot of investors are curious about your business in China, especially as the U.S. and China renegotiate their trade relationship. Yeah. You have a joint venture with Alibaba. How do you view your China business right now?
Well, we are very optimistic about China. Now, China in our business is a travel business principally for Chinese travelers. Shanghai is the most international city in China. We have about 40 hotels open. They tend to all be luxury hotels or very, very elaborate hotels. The majority, even in that city, of the guests that we welcome are Chinese travelers. Chinese travel is obviously growing significantly as the Chinese economy moves towards more of a consumer economy, both for within China travel and Chinese traveling abroad. And so we want to make sure our brands are well known, that they're thought well of. Our partnership with Alibaba is really a way of intensifying a Chinese welcome to Chinese travelers when they travel abroad by delivering in-language, breakfast, other services that are what the Chinese traveler is really looking for. And I think in some respects that story won't change even in a trade war. The Chinese will continue to move towards a consumer economy, they'll continue to love travel, they'll be interested in seeing the rest of the world. But there are risks, obviously, in the way trade impacts economic activity between the two countries, and economic activity too is a driver of travel. And so we're watching this closely and I guess hoping against hope that we end up pulling back from the brink and we don't end up in a trade war with China or other markets around the world.
And back here in the U.S., it's hard to complain about the U.S. economy. Unemployment rate at 3.8%. Things are going relatively well across the board. How do you view the economy from where you sit? You're dealing with higher construction costs, but maybe that's a symptom of the good economy that we're seeing.
Yeah, I think it's been very interesting. Obviously, since I last saw you, we've seen tax reform get enacted now 6 months ago, almost, end of December. And that was a jolt of optimism for the economy. Obviously also a jolt towards corporate profits, to some extent towards individual after-tax earnings. And so it really feeds a kind of optimism. And I think as a consequence we feel a bit better about the economy today than we would have a year ago. Having said that, it's not as if we're in a boom market across the United States. I think we still have companies that are under financial pressure because of disruptors or because of cost growth at the same time, because of transparent pricing, all of those sorts of things. And so we see the economy growing maybe marginally faster than it was growing a year ago, but it's not as if we're already seeing proof that we're at a material step up in economic activity, though the optimism is there, and optimism by itself can feed, obviously, better growth going forward.
And Marriott did something very interesting with the tax cut windfall. You guys actually invested in employee retirement benefits, aside from just giving someone a raise so they can go out and buy more stuff. You invested in something that a lot of Americans out there are not doing enough of, which is saving for retirement.
Yeah, that's right. I mean, we have talked internally at Marriott for years about are our people ready financially for retirement, from a housekeeper all the way up through the management ranks of the company. And the biggest single thing that can be done is to make sure people sign up and participate in those programs. And what we really wanted to do was drive that. So we had, before we did this, about 70% of our associates participating in our retirement programs. We decided, let's give a $1,000 bonus in effect, 5-for-1 match. So all you'd have to do is put $200 into your Marriott retirement plan, and you'd get 5 times that immediately as an incremental company match, so that it would be silly not to sign up. And again, the notion there is we're taking about $120 million this year in 2018, and saying to our associates, particularly those who need it most, which means those at the mid-ranks of the company and down, sign up for this program. It's going to be in your interest long term, and we want you to be ready for retirement when it comes.
And before we go, it's hard to top your acquisition of Starwood from a few years ago, but would you be open to doing any more M&A activity in the coming years? And if so, what targets seem attractive to you?
Well, we always have our eyes open, and while we are thrilled with the way the Starwood acquisition has gone and have a big company, we are, in terms of global market share, probably less than 10%, 7 or 8% of all hotel rooms. So it's not as if we are with a massive share already. We expect we'll continue to grow share through organic growth. Our teams around the world are signing more than 2 hotel deals a day, and those will open in the future, so that growth will continue. And then we'll look to see if we can't continue to grow in markets where our distribution is relatively weaker, or with brand areas that we could be stronger in. And we'll see what opportunities present themselves.
Okay, Arne Sorenson, we'll leave it there. Thank you so much for joining me.
Thank you very much. Great to see you.